Dear investors, welcome to the May and June 2026 monthly roundup video. I was waiting for any conclusive news on the US-IRAN war to make this video. They have agreed and signed a 60-day memorandum of understanding on 19th of June 2026 that establishes a formal negotiation window aimed at reaching permanent peace and nuclear settlement. The real progress will be known only after the 60 days are over. But the more important development because of this is Brent crude price falling from $110 at the start of May to almost $73 on 30th June. Maritime traffic has increased significantly in the Strait of Hormuz with India government removing the ban on bulk purchase of petrol and diesel from July 1st. The USD INR rate has also reduced from an all-time high of 97 rupees to almost 95 rupees per dollar now. RBI also approved a dividend transfer of rupees 2.86 lakh crores to the government in the year FY 25-26. This will help cushion some of the shortfall in the tax revenue of the government because of the excise duty cuts in petrol and diesel prices. The inflation rate came in at 3.93% for May 2026, which is slightly higher than in April. The government has so far done a good job in shielding the Indian economy and the retail consumers from the external shocks of war. At the same time, they have kept our current account deficit and fiscal deficit in check. Of course, data released in October to December 2026 quarter will give more clarity on these aspects. Now let's see what has happened in the Indian share market in the past 2 months. Nifty Small Cap 250 Index has gone up 5%, Nifty Mid Cap 150 Index has gone up 3%, Nifty 500 Index has gone up 1%, and Nifty 100 Index is almost at the same point as it was 2 months back. So much anticipation. The market will crash 15 to 20%. Dollar will reach rupees 100, crude oil will hit $150, and so on. Think about all the time spent reading news articles trying to predict the future, listening to every expert or pseudo expert for advice on whether to change or diversify your portfolio, watching endless political debates, following self proclaimed intellectuals, and trying to figure out when the war will end. Honestly, ask yourself, was any of it really worth it? All one can do as a sensible investor is find a good financial advisor whom you can trust and follow their advice with respect to portfolio allocation and be done with it. No news, no fuss with respect to investing. If you are a long term investor with 7, 10, or 15 years time horizon who is investing a large portion of their savings into mutual funds, then believe me, a good advisor, a good valuation based strategy, patience and mindset to sit through day to day volatility is all you need to make good returns in your portfolio. If you are looking for some action, then you can watch Durandar, or a new movie has come, Ma Inti Bangaram. I have heard good reviews about it, or even WWE. Please leave your portfolio out of unnecessary action based on hunch or news or chat GPT. Another important observation I would like to share with you. NAC released a research paper in October 2025 on Nifty 500 index, the most diversified index in India. It comprises of all the stocks of Nifty 100, Nifty Mid Cap 150 index, and Nifty Small Cap 250 index, a total of 500 stocks representing 91% of the market capitalization. As you can see, the annual volatility of Nifty 500 index over different time periods varies from 13% to 18%. In simple terms, what this means is that during 1 year, if Nifty 500 index made a high of 100, then at any time during the same year, it could make a low of 82 to 87. So the difference between annual high to low is called annual volatility, which is between 13 to 18%. It may so happen that Nifty 500 could make a high of 100 in the year 2021 and make a low of 70 in the year 2023. So over 2 years, the difference between high to low is 30, which when averaged out leads to an annual volatility of 15%. Now, why am I sharing this observation with you? Suppose you are an investor who has invested lump sum funds in Nifty 500 when it was at 85 and now it's at 100. So, volatility worked in your favor and you made a return of 17%. On the other hand, if you had invested lump sum funds in Nifty 500 at 100 and now it's 85, then volatility worked against you and you would have made a loss of 15%. Which is why we say investing in mutual funds is subject to market risk, the greatest of which is volatility. Of course, when an investor is doing SIPs rather than lump sum, then he or she will be able to ride out some of this volatility. So, a good rule of thumb to remember whenever you start investing into mutual funds is that your portfolio can go down 15 to 20% anytime. It may happen next day, next month, next year, or a few years down the line. That way, you will be mentally prepared when the volatility in the market increases and there is such a sharp fall in the market. Also, you won't be scared or do something irrational with your portfolio in such a bad time, which you will regret later. I hope this video has been useful. Thank you. Happy investing.